The Fed hasn't even gabbled in yet, and options desks are already pricing a 1 in 3 shot. It ends in a surprise hike tomorrow. Good morning, it's Tuesday, July 28th. I'm Nick Vertucci with Eleanor Whitfield and Marcus Brooks. Grab your coffee, because yesterday's truce rally didn't survive first contact with the chip complex, and today the Fed actually starts meeting. We'll recap Monday, walk through what's on deck today, and get into that hike odds number, because it's stranger than it sounds.
Morning, Nick.
Morning, and stranger than it sounds is putting it kindly.
Before any of that scoreboard time, you each left us a checkable call yesterday morning. Eleanor, yours was the 10-year, ease at least 10 basis points off Friday's 4.741% by today's open, or the bond market isn't buying the ceasefire as durable.
And it didn't get there, not quite. The 10-year closed Monday at 4.65%, which is about 9 basis points off Friday, just short of my line. I'm calling that a win, even though it's a narrow one. The market's easing, but grudgingly, not with conviction, which is actually exactly the read I was making.
I'll allow it. 9 is basically 10.
9 is not 10, Marcus, but I appreciate the generosity.
Marcus, yours was rougher. NASDAQ closes up at least 1% Monday, or the market's more nervous about Wednesday and Thursday than anything happening that day.
Yeah, that one's a loss, clean. NASDAQ closed down 0.6%. Intel dragged the whole chip complex with it despite beating on every line. I underestimated how much that single stock could poison the tape. I'll take it.
No hedge?
No hedge. Wrong is wrong. Marcus is now 5-9 on the quarter, on the 2-game skid.
And I'm 7-5, 2 in a row now.
Noted, and we'll do this again tomorrow. Let's get into what actually happened.
So start with the headline number, because it undersells the day. S&P up 3 points, basically flat at 7,412. The Dow was the story, up 236 points, 0.5% to nearly 52,000. 10 of 11 sectors finished green.
And the 11th sector is the only one anybody's talking about this morning.
Right, technology. It's the one red sector, but it carries enough index weight that it dragged the NASDAQ down 0.6% all by itself. Real estate and materials rallying 2% be damned.
What does the VIX tell you underneath that split?
It crept up to 1858, its highest close in about a month. Small move, but directionally it's saying options desks are paying up for protection even on a day the headline index barely budged. That's a market hedging quietly, not panicking loudly.
I'd call that healthy caution, not fear. 18 and change isn't a stress reading, it's a we've got a loaded week ahead reading.
And the name everyone's asking about is Intel.
Intel is the whole story, honestly. Beat revenue, beat EPS by roughly double, beat margins, raised guidance, and closed down almost 8%. Same stock popped nearly 13% after hours Thursday night on the print itself, then gave all of it back and then some, once people did the math on the $20 billion capex number.
This is the pattern I keep flagging. A beat in raise isn't grace anymore if the spending behind it doesn't look like it converts to cash soon. Intel's foundry segment is still losing $2.1 billion a quarter on just $293 million in outside revenue. And now they're telling you 27 spending goes even higher than 26's $20 billion.
Sure, but the underlying process work is actually working for once. 18A yields running 25% above internal targets, up over 50% quarter over quarter. That's the first time in years Intel's roadmap has been ahead of its own promises instead of behind them. The market's punishing the bill before it's given the turnaround any credit at all.
I don't think that's punishing it too early. I think it's the market finally pricing execution risk correctly after ignoring it for 2 years. Same day, SAP beat and got bought, up 7%. Intel beat bigger and got sold. The difference is cash flow, not effort.
Give me the one-sentence version for someone who just wants to know if their Intel shares are fine.
The business is genuinely improving, but you're being asked to fund another year of losses before you see it. And the market decided Friday it wants proof, not a roadmap.
I'd add one thing before we move on, though. The government, sitting on paper gains worth tens of billions on its stake, bought near $20.47 a share. That's not nothing for the turnaround narrative, even if it didn't stop Friday's selling.
It's a real number, I just don't think it changes what a private investor is underwriting this week.
And the flip side of that same coin landed after the bell, Cadence.
Cadence is basically the un-Intel story from the same night. Beat on both lines, raised full-year revenue guidance to $6.26 to $6.34 billion, raised EPS guidance too, stock up over 4% after hours to around $3.52. Rambus beat too. Applied Digital's hosting revenue was up 407% year over year.
Notice the thread though. Everything that got rewarded touches AI infrastructure or chip design directly. Everything that didn't, like Universal Health Services beating revenue and still getting hit for soft margin guidance, got sold. It's the Intel pattern in miniature, twice in one night.
And that's already showing up this morning. Synopsys is higher in pre-market trading, catching a read-through bid off Cadence's raise on top of its own news expanding an NVIDIA partnership for AI-assisted chip design.
Which tells you the design software corner of this trade is fine. It's specifically the how much capex, how soon does it pay off question. That's live, not whether chips broadly are in demand.
And Applied Digital's 407% hosting revenue number, is that a real signal or just a small company with an easy comp?
A bit of both. It's a small base, so the percentage flatters it. But directionally, it's the same story as Cadence. Actual AI data center demand is still showing up in bookings, which is a genuinely different question from whether the companies funding all of it can afford the bill.
Right, and that's the distinction that keeps getting flattened into one big AI trade headline when it's really two separate trades wearing the same jacket.
Let's move to the thing that started the whole week. Oil. Eleanor, you set a tell Monday morning. Does Brent keep drifting lower, or does it snap back on a headline? Where are we?
Drifting lower so far, that's the honest read. Brent's down again this morning into the mid-80s, extending Monday's slide. That's the second straight session of grinding lower rather than a sharp reversal, which is the pattern I said would tell us the de-escalation is real.
I'll give you that one's trending your way, but I'd flag the actual headlines under the price action. Tehran is publicly denying there's a formal 10-day ceasefire agreement even as the pause itself holds. And Trump's language is good talk's chance of a deal, with an explicit warning strikes resume if they fail.
Which is exactly why I'm not calling the risk premium gone. I'm calling it paused, same as Monday. A pause with an explicit resume if it fails clause attached to it isn't peace, it's a ceasefire on a very short leash. I want to see this hold through Friday before I use the word durable.
Fair, and I'd add, even a leash this short is worth something. 2 straight sessions of oil grinding lower is real relief working through gas prices and inflation math, whether or not Tehran signs anything on paper.
What actually breaks the pause in your readie? Is it a single strike, or does it take a pattern?
One credible strike on shipping through Hormuz undoes this in an afternoon. That's the whole problem with calling a pause a piece. The downside reprices instantly, the upside takes weeks to earn back trust.
Which is fair, but cuts both ways. It also means every day it doesn't happen is a day the market gets more comfortable pricing it as the new normal, not the exception.
So walk me through why that actually matters for the Fed, because that's tomorrow's whole ballgame.
It complicates Warsh's job rather than simplifying it. Cheaper oil takes pressure off headline inflation. But he's been careful all month to separate energy-driven price moves from the underlying inflation fight he keeps saying is still too high. 2 days of easing crude doesn't erase that distinction for him.
Which is a clean pivot into the number that opened the show, a 1 in 3 chance of a surprise hike tomorrow. Where's that even coming from?
It's a real jump, and it's not really about oil at all. It's geopolitical and trade risk premiums showing up in rate hike pricing alongside the baseline 83 to 85% odds of a hold. Markets don't usually price a 1 in 3 tail on a meeting everyone called boring 2 weeks ago.
I'd push back on calling it strange, though. It's the market doing its job. If Warsh is genuinely worried about a re-acceleration in prices, sitting on his hands after a violent geopolitical month is exactly the kind of setup that produces a surprise. I don't think it happens tomorrow, but I don't think 1 in 3 is crazy pricing either.
Play it out for me. What actually changes at your desk if he hikes tomorrow instead of holding?
Every rate-sensitive trade this month gets repriced hard and fast. REITs, small caps, anything that just rallied Monday on the value rotation. It would be the loudest signal yet that whoosh means prices are too high, literally, not as a talking point.
And I think it doesn't happen. For the same reason I've been saying all week. Labor's soft, oil's now helping him, and surprising the market a day before 4 mega-cap earnings reports is a strange hill to die on. My number's closer to 5% than 33.
What would actually change your mind, Marcus? What would make you take the 1 and 3 seriously?
Honestly, if consumer confidence surprises hot this morning on top of the oil relief, that combination, households feeling fine and energy costs easing, is about the only setup where I'd start taking a surprise hike seriously myself.
That's a fair tell, and I'd watch it too.
Tough real split, Eleanor. Giving real odds to a surprise. Marcus, dismissing it almost entirely. We'll know by 2 o'clock tomorrow.
We will.
Now, the bond market actually cast its own vote yesterday, and it split down the middle, the 2-year and 5-year Treasury auctions.
And it's a genuinely strange split. The 2-year was one of the cleanest auctions in months. Bid to cover at 2.662, the highest since January, indirect bidders taking almost 57%, dealers left holding under 10%, the least since January. Strong, healthy demand.
And the 5-year was the ugly twin, tailed for the 14th straight auction, worst bid to cover since September of 2022.
Give me the plain English version. What does a tail actually mean?
It means the winning yield came in higher than where the market was trading right before the auction closed. Buyers demanded more compensation than dealers expected, which reads as soft demand at that specific maturity.
So which one do I believe? The strong 2-year or the weak 5-year?
Both, honestly, and that's the interesting part. Investors are comfortable parking money short-term where the Fed's path is clearer, but they want more yield to commit out to 5 years with a hike still on the table and a war that's paused, not over. That's not one signal. It's the market hedging its own uncertainty across the curve.
I'd read it a little more simply. The 5-year's been ugly for 14 straight auctions. This isn't new information. It's a persistent technical issue with that specific maturity, not a fresh verdict on tomorrow's Fed meeting.
14 straight. Is that actually a structural problem? Or are we overreading a slow-moving trend because it's Fed week and everyone's looking for signals?
Probably some of both, honestly. It's real. Dealers have been asking for more concession at that maturity for over a year now, but you're right that Fed week makes people read new meaning into an old pattern.
Hold that thought. We've got the whole rest of the week to relitigate the 5-year. Let's get to today, because it's not just Wednesday's Fed that's on the tape.
Consumer confidence and the Case-Shiller Home Price Index both land at 10 Eastern, plus the Richmond Fed Manufacturing Survey the same hour.
Consumer confidence is the one I'd actually watch. It's a read on whether households are still spending confidently into a Fed decision, right after ADP flagged private hiring slowing for 4 straight weeks. If confidence cracks on top of that hiring slowdown, that's 2 soft data points landing the same week the Fed's deciding whether it even has room to be patient.
Case-Shiller's more of a lagging check than a market mover at this point. Home prices tell you where things stood a couple months ago, not where they're headed. I wouldn't build today's narrative around it.
Agreed, though a soft print there would just add to the consumer's tiring out thread that's been building all month.
And Richmond Fed?
Regional Manufacturing Survey, smaller staged than the New York or Philly versions, but worth a glance for whether factory activities holding up outside the coasts while everyone's fixated on chips and big tech.
And futures this morning?
Mixed to slightly higher, nothing like Monday's pre-market pop. This is a market in wait-and-see mode into a 2-day Fed meeting, not one still chasing yesterday's ceasefire relief.
All right, before we get to Wednesday and Thursday, one non-market thing. Eleanor, you copped 4 cups of coffee yesterday by 7 a.m. How many so far this morning?
2, and it's not even 8. It's a big week, Nick.
Structured caffeine intake, week 2.
I'm trademarking it.
Duly noted. Back to it. Wednesday and Thursday, same test you two set up Sunday and haven't moved off since. Microsoft and Meta report Wednesday after the close, same afternoon as the Fed decision. Amazon and Apple Thursday. Where do you each stand this morning?
Exactly where I was. Intel's reaction Friday only strengthens my case. The market showed you this week. It will punish spending that doesn't obviously convert to cash, and Alphabet already went cash flow negative. 2 or more of the 4 selling off the way Alphabet and Tesla did, and I think this is a confirmed repricing.
And I'm still on the other side. Microsoft and Meta have real profitable engines funding their spend. Azure, the ad business, that's a different animal than Alphabet's specific negative free cash flow quarter. Intel's a chip maker funding its own foundry build-out. That's not the same balance sheet question as a hyperscaler with existing cash-generating businesses underneath the capex.
I hear the distinction. I just don't think the market's going to draw it as cleanly as you're drawing it right now, especially not the same week the Fed might surprise everyone.
We'll know by Thursday night. I'm not moving off it before then.
Quick separate read on Thursdays too, because Amazon and Apple aren't the same story as each other, let alone as Wednesday's pair.
Amazon's the one I'd watch hardest of the 4, still. AWS carries the same CapEx versus payoff question as Google Cloud, but there's a retail business bolted on that muddies the read either way you want it to go.
Apple's closer to a control group, smaller AI capex commitment, no giant infrastructure build-out to defend. If Apple gets sold anyway Thursday, that's guilt by association with the sector, not a verdict on Apple's own spending.
Stillman, her case for me. Quickly, if you had to argue Eleanor's side for 30 seconds, what's the strongest version of it?
Fine. The strongest version is that once the market decides a whole category, AI capex, is the thing it's punishing, it doesn't wait around to read each company's balance sheet carefully. Alphabet sets the pattern. Everyone gets swept in regardless of the details. That's a real risk to my case. I just don't think it's the base case.
I'll take that. That's exactly my case, actually.
Good. You two are exactly where you left it Sunday, and I'm not going to force it. Here's the marker for our listeners. Watch Wednesday and Thursday afternoon. That's when this actually resolves, not from anything said on the show. All right, closing calls, 1 apiece, checkable by tomorrow.
Mine's on the statement language. If Warsh's Wednesday statement or press conference keeps a September move explicitly on the table, I think I'm right that this week's oil relief hasn't actually changed his thinking. If he hedges that away entirely, I'm wrong.
Mine's on the chip complex specifically. I think semiconductors outperform the broader NASDAQ tomorrow. On Cadence and Synopsis's read-through carrying into the sector even with Fed day jitters. If chips lag the index instead, that tells you Intel's scar from Friday hasn't healed yet.
2 checkable calls, and Wednesday afternoon settles both of them along with everything else this week's been building to. So here's today, oil grinding lower for a second straight session, a split verdict from yesterday's Treasury auctions, consumer confidence in Case-Shiller at 10 Eastern, and all of it sitting in front of a Fed decision tomorrow where the market's pricing real odds of a surprise. If the show's useful to you, follow Nova Ventures Daily wherever you get your podcasts, and find our daily charts and reels on Instagram at NovaVentures_US. That's your Tuesday morning brief. Have a great day, and we'll see you tomorrow.